Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Thanks for having me. And there is definitely a lot to break down today.
If you look back at early 2026, millions of investors basically bet everything they had on one absolute sure thing, which was, sweeping interest rate cuts.
Right, everyone was so certain.
Exactly. But by May, those rate cuts practically vanished. And, well, countless portfolios just got completely wiped out. So today, in this deep dive, we're exploring why the smartest investors actually plan on being completely wrong.
It really is the ultimate paradox of investing. If you're an American investor trying to navigate things right now, your goal shouldn't be to perfectly predict the future.
You just can't, right?
Exactly. I mean, the markets in May 2026 are juggling this dizzying mix of factors. You've got the Federal Reserve holding interest rates hostage, unpredictable energy prices from the Middle East conflicts, and the realities of new tariff policies under the Trump administration.
Oh, and the massive AI boom, right? The whole capital expenditure cycle.
Yes, that too. So our mission today is really to help you build a decision-making structure that survives, no matter what the market actually throws at you.
And we really need to define what that AI capital expenditure cycle actually means for the everyday investor. Because it sounds like Wall Street jargon, but we aren't just talking about software updates here.
No, not at all. It's highly physical.
Right. We're talking about the physical reality of building AI. Tech companies are pouring hundreds of billions into real estate, copper wiring, massive cooling systems, and, entirely new power grids just to keep these data centers running.
It's basically a global construction boom.
Yeah. And trying to guess exactly how all of these massive global forces will play out together, it's impossible. Which brings us to probabilistic thinking.
Which is the core of everything we're talking about today.
Right. But before we can learn to think in probabilities, we have to unlearn our very human habit of betting everything on a single guaranteed future.
Yeah, we like certainty. And that habit played out in a really painful way earlier this year. Based on recent analysis just a few months ago, investors aggressively built their entire strategies on one big assumption.
That borrowing money was about to get cheaper.
Exactly. The whole market priced in multiple aggressive Fed rate cuts. People bought up stocks and structured their assets with, absolute certainty.
But fast forward to right now, and global brokerages have drastically slashed those expectations. Okay, let's unpack this rug pull for a second.
Sure.
Because to a lot of people, the economy felt fine, and then suddenly the math just changed overnight. I like to use a weekend trip analogy here. If the forecast says there's a 70% chance of sunshine and a 30% chance of rain, you don't only pack swimsuits, right? You throw an umbrella in the bag just in case.
Right, because you acknowledge the 30%.
Exactly. But in investing, people pack only for the sunshine. So how did the rain actually sneak up on everyone this year? It really comes down to the mechanics of inflation, right?
It does. So early in the year, a conflict in the Middle East flared up, which immediately threatened oil supplies and pushed global energy prices up.
And higher oil prices mean everything else gets more expensive.
Exactly. It costs the logistics company more money to fuel their cargo ships and trucks, so they pass that cost on to the consumer. Groceries stay high, basic goods stay high. And at the exact same time, U.S. employment data came in surprisingly strong.
Wait, that sounds like a good thing. If Americans have jobs, they have paychecks.
It is fantastic for the everyday worker, but a strong job market means consumers keep spending. And that robust spending creates demand, which keeps prices stubbornly high.
Ah, I see.
So because of those two mechanical factors, expensive energy and high consumer spending inflation remains super sticky, the Fed, whose primary job is to fight inflation, was forced to stay on guard.
Wow. So now some analysts are saying we might see 0 rate cuts this year.
0. And those investors who banked everything on that single rate cut scenario, they completely miscalculated the probability distribution. They planned for 100% sunshine and got caught in a downpour without an umbrella.
Man, that hurts. But, I look at human nature and I have to wonder why we keep falling into this trap. If betting on a single outcome is so dangerous, why is it our default setting?
Well, it's mostly a psychological illusion. When we look backwards at the stock market, the past always looks like a perfectly straight, obvious line.
Oh, totally. Looking at a stock chart from a year ago, it seems so incredibly obvious what we should have done.
Right. But in decision theory, falling for that illusion is called resulting. It's when we judge the quality of decisions strictly by its outcome, completely erasing the real uncertainty that existed at the moment the decision was made.
I always think of it like a hand of poker. You can play a hand with perfect mathematical strategy, right?
Mhm.
You calculate the odds, make all the right bets, and still lose to a lucky card drawn by your opponent at the very end.
Yes, exactly.
The fact that you lost your money doesn't mean your initial decision was bad. You just caught the bad end of the probability.
That is the perfect way to look at it. What's fascinating here is that a good decision can yield a bad result, and a terrible, reckless decision can get lucky and yield a good result. But long-term survival is about repeating a good process.
Okay, so how does resulting blind us to what's happening in the markets right now? Because I look at the market over the last month, and it feels like stocks have just been ignoring the bad news.
We actually saw this vividly in mid-April 2026. The data shows a really fascinating split reaction across different asset classes.
A split reaction, how so?
Well, geopolitical tensions in the Middle East seem to calm down slightly on the surface. Because of that brief pause, the U.S. stock market, the dollar, and volatility indexes all stabilized.
So stock investors looked at the outcome and said, great, the risk is over.
Exactly. But at the exact same time, the bond market was taking an absolute beating.
Wait, let's unpack the mechanics there. If I'm an investor holding bonds, why am I panicking while the stock market is popping champagne over the exact same global events?
Because bond investors were hyper-focused on a completely different set of probabilities, specifically that sticky inflation we just talked about.
Okay, right.
Let's look at how a bond actually works. If you buy a U.S. Treasury bond that pays you a fixed 4% interest rate every year, but inflation is running at 5%, the purchasing power of your money is actually shrinking.
You are literally losing money in real terms every single year.
Right. Inflation is the ultimate enemy of a fixed income asset. So the bond market was pricing in the very real probability that high oil prices were going to keep inflation alive.
Which means the stock market and the bond market were living in two completely different realities.
Exactly.
And if you only looked backward at the stock market's positive result, you'd falsely conclude that the risk was over. You would completely ignore the valid, inflation-driven warning signs the bond market was flashing.
Precisely. If you judge the past only by the stock market's result, you learn the wrong lesson and leave yourself vulnerable.
Here's where it gets really interesting, though. If hindsight blinds us to what could have happened, how do we train ourselves to factor in the ghosts?
Ghosts.
Yeah, the ghosts, those events that were highly probable, that we actively worried about, but they never actually materialized. How do we account for things that didn't happen without just becoming paralyzed by fear?
Oh, that's a great question. Tracking the ghosts isn't about paranoia, It's about staying balanced.
Right.
Let's go back to the AI boom. Over the last year, even as major AI tech stocks skyrocketed, you have to remember the very real risks that existed while they were climbing.
Like the supply chain stuff.
Yeah, severe supply chain bottlenecks for microchips, legitimate fears about power grid shortages, and extreme worries that the valuations were just way too high.
Right. If I drive to work and don't get into a car crash, that doesn't mean wearing my seatbelt was a stupid, fearful decision.
Yeah.
The risk of the crash was real, even if I arrived safely.
Exactly. And we had a perfect macroeconomic example of this ghost tracking just recently. On May 12, 2026, the U.S. and Japan held discussions about the historically weak Japanese yen.
Oh, I remember this.
Yeah, leading up to it, the global markets had braced for a very severe warning from the U.S. about excessive currency volatility. People expected massive market shifts.
But that didn't happen, right?
No. Instead, the U.S. Treasury Secretary's remarks were surprisingly moderate. The warning was soft, so the dollar-to-yen exchange rate just wobbled a bit instead of crashing.
Okay, so a meeting happened, a statement was made, and nothing exploded. Why does a wobble in the Japanese yen matter to, like, a beginner investor living in Ohio?
Well, because foreign currency directly impacts U.S. stock prices. If the yen collapses, Japanese goods become incredibly cheap globally.
Which hurts American manufacturing companies trying to export their own stuff.
Exactly. Or, in a more extreme scenario, to prop up their currency, Japan might be forced to sell off massive amounts of U.S. Treasury bonds, which would immediately spike interest rates here in America.
Wow, okay.
So going into that May 12th meeting, multiple realities existed simultaneously. Japanese government intervention, a Bank of Japan rate hike, or U.S. tolerance. Just because the extreme warning didn't happen doesn't mean the risk wasn't incredibly real.
Right. And if you erase that ghost from your memory and tell yourself currency meetings don't matter, You'll be totally unprepared the next time a currency crisis actually does trigger a U.S. stock sell-off.
Which is why we have to move from these abstract probabilities into a concrete game plan. We need to build a scenario playbook.
See, I want to push back on this idea of building a disaster playbook right now.
Okay, why is that?
Because, honestly, the market feels pretty calm.
Mm-hmm.
I look at my portfolio and it's like driving on a sunny day on a newly paved highway with no traffic. Why do I need to map out catastrophic scenarios right now? Doesn't a calm market just mean things are healthy?
I get why it feels that way, but a calm surface doesn't mean the engine under the hood isn't overheating. Based on recent data, in early May, the VIX, which Wall Street calls the fear gauge, dropped to a 3-month low. It actually fell lower than when the Iran conflict escalated earlier in the year.
Wait, really? People were officially less scared in May than they were when actual missiles were flying. That feels incredibly dangerous.
It is dangerous. That low VIX is a classic signal of complacency. It suggests investors are severely underestimating tail risks. This is exactly why you must do scenario analysis when the sun is shining.
Okay, so let's map it out. What are the active scenarios global investors need to plan for in 2026? What's the first path?
Scenario 1 is high rates for longer. In this world, the Fed simply cannot beat that sticky inflation, so they keep interest rates high indefinitely.
And mechanically, who wins and who loses there? I imagine companies that rely on heavy borrowing get crushed.
Exactly. High-priced tech startups that don't make a profit yet suffer massively. Long-term bonds also suffer. But quality companies with strong, immediate cash flow win. Short-term bonds also win because you get a high yield without being trapped.
Okay, that's the annoying but manageable scenario. What is scenario 2?
Scenario 2 is a fast economic slowdown. The high interest rates finally choke the economy, consumers stop spending, and we hit a wall. The Fed is forced to aggressively cut rates to save jobs.
So in that world, long-term bonds suddenly become incredibly valuable, right? Because if the Fed cuts new rates to 2%, the 5% bond I bought last year is suddenly gold.
Precisely. Quality growth stocks do well, too. Gold and defense stocks typically win here as people seek safety.
And what's the third path? The disaster scenario.
Scenario 3 is the triple shock. This is a simultaneous hit. A geopolitical conflict spikes energy prices, combined with severe global tariff risks, which, we really have to monitor given the aggressive trade policies favored by the Trump administration.
Right. If new tariffs spark a global trade war while energy prices surge, supply chains just freeze up.
Exactly.
So inflation explodes, but economic growth dies.
Stagflation. Where on earth do you hide in that scenario? In a triple shock, stocks and bonds both drop. The only true safe havens are holding U.S. dollars, gold, and keeping your personal debt as low as possible.
Okay, so we can map out inflation, recessions, or tariffs because we know the rules of those games. But looking at history, the things that really wipe people out are the things that aren't on any spreadsheet.
Yes, the black swans.
Right. So what does this all mean when a true black swan hits? How does an everyday investor protect their money from an unknown risk?
Well, it requires understanding the difference between knowable risks and unknowable risks. Knowable risks are earnings, interest rate paths, tariffs. We can model those.
And the unknowable ones.
Those are sudden bank failures, pandemics, or massive regulatory shocks. If we connect this to the bigger picture, probabilistic thinking means accepting extreme humility. You can't predict everything, so you have to build a portfolio that simply doesn't blow up when the unexpected occurs.
Give me an example of an unknowable risk brewing in the shadows right now. Something a beginner wouldn't even know to look for.
There's a stark example from mid-May 2026. Following Kevin Warsh's nomination for Fed chair, global financial circles started quietly worrying about the politicization of the Federal Reserve.
Oh, wow. Okay.
Yeah. Specifically, there are fears regarding the Fed's $6.7 trillion balance sheet runoff and these things called global dollar swap lines.
Okay, wait, let's translate those mechanisms. First, the balance sheet runoff. The Fed essentially printed trillions of dollars during past crises to keep the economy afloat. The runoff is just a technical way of saying the Fed is now systematically destroying that printed money to cool down the economy.
Correct. It's a delicate process.
Yeah.
But the second part, the dollar swap lines, is even more critical. Foreign economies run on U.S. dollars the way a human body runs on blood.
Right.
When a crisis hits, foreign banks desperately need U.S. dollars to survive. A swap line is essentially an emergency blood transfusion from the Fed to a foreign central bank. Historically, this has been a purely mechanical, stabilizing tool.
So what happens if that transfusion becomes political? Like if a foreign country does something Washington doesn't like, and the U.S. threatens to cut off the swap line.
It changes the entire foundation of global finance. If these swap lines become tied to political conditions, it becomes a weapon. It creates a massive, unpredictable tail risk that no standard financial model can
Well,
time.
because if a foreign bank goes under because it couldn't get dollars, that contagion spreads to U.S. banks within hours.
Exactly. It's completely invisible until the exact moment it snaps.
That is terrifying. Which brings us to the most practical part of this deep dive. We understand the theories and the massive global risks. But tomorrow morning, when an investor logs into their brokerage account, how do they actually make a decision?
It comes down to establishing strict, unemotional rules for risk management, specifically position sizing.
I compare this to having an emergency brake on a train. It's not about keeping the train permanently parked in the station because you're terrified of a crash. It's about knowing exactly how much pressure your emergency brake can handle before you even leave the station.
That is a brilliant way to frame it. People assume that thinking about multiple contradicting futures makes you hesitant. But probabilistic thinking actually cures investor hesitation.
Really? How so?
It completely removes the emotion from the buy button. Instead of blindly buying a stock because AI is the future, you buy it because you've done the math.
You say, I believe the upside of AI infrastructure growth outweighs the potential losses if interest rates rise. But my position size is small enough to survive the worst-case scenario.
Yes. Position sizing is how you break free from single-story investing. Let's look at the US dollar right now. The dollar might strengthen because global investors are scared of those Middle East conflicts and demand a safe haven.
But simultaneously, the dollar could weaken due to fiscal debt
Yeah.
or those fears about the Fed losing its independence.
Exactly. Or consider Bitcoin. Wall Street recently packaged Bitcoin into ETFs, making it super easy to buy. Those massive ETF inflows could easily make the price surge.
But Bitcoin is still a high-risk asset. So, if a global liquidity crisis hits, say, because a dollar swap line is cut off, Bitcoin might be the very first thing investors panic sell to raise fast cash.
Exactly. Assets do not have a single destiny. Therefore, the absolute golden rule of probabilistic thinking is this. Even if you are 70% sure you are right, you do not bet everything. You focus first on one question. What do I lose if I'm wrong?
What do I lose if I'm wrong? It forces you to look at the downside before you fantasize about the upside.
It shifts your identity from trying to be a genius forecaster to being an excellent risk manager who survives.
That's so powerful. True investing isn't about being the loudest voice in the room who gets the future perfectly. It's about extreme humility. It's the willingness to constantly update your beliefs when new information arrives.
Absolutely. Survival is the only thing that allows you to stay in the game long enough for compound interest to actually work.
The ultimate superpower isn't prediction, it's survival. So look at your own portfolio right now. Are you prepared for multiple futures? Or are you betting your entire retirement on a single weather forecast? Something to mull over this week. Don't forget to subscribe and hit that like button.